Okay, hi everyone. Welcome to Master Key Associate. Tonight we are going to continue with the investment appraiser and financial management. Investment appraiser, financial management. So far we have looked at this concept and we have treated two examples or three, get about. But the question we are going to treat tonight, class, is the kind of question you will come across in your exam, because this is a question that involves, okay, that contains all the necessary components of investment appraiser. Exactly. All the necessary components of investment appraiser. Okay. Sorry. So I want us to please, okay, to really pay serious attention. It's very, very important, please. So straight away, class, look at that question in your material, Timothy Nigeria PLC. Out there. Timothy Nigeria PLC. That is question number 3, right? Timothy Nigeria PLC. Tonight, I am going to appoint 2 people to be my figures fact checker. 2 people. Let me see their name here. Calista. Hello, can you hear me? Calista.
Yes, sir, I can hear you.
Okay. Tonight I am appointing you as one of my figures checker. Okay. Number 2, let me also appoint Azuka. Azuka. Hello, can you hear me? Azuka. Okay.
No, sir. I can hear you.
Okay. You too. And Jennifer. Jennifer Eki. So 3 of you, please be my figures checker. Okay. Once I calculate with me, then you just check what I have gotten. Exactly.
Okay, sir.
Because of this question. Okay, thank you.
Okay, sir.
Now, recall that under appraiser, you need 3 things. Number 1, the number of years of the project, right? Number 2, the relevant cash flows. And by now, you have understood the concept of relevant cash flows, because it is not all the cash flows that are relevant for decision making. Is that clear? Number 3, the appropriate or relevant discount factor. Is that clear? So let's go in now. So number 3. Now, Tony Nigeria PLC is the listed company out there which plans to increase demand. You see, I want to stop now this question for the sake of those who are not our students here. Exactly. So please, everybody, let us go through it now. Okay, let us go through it together, please. So here you can see that the cost of the new machine is 5 million. Exactly, is 5 million. Note that. 2, the scrap value of the machine is 5% of the initial cost. Exactly, is 5% of the initial cost. Take note of that. You know, normally they will give you the scrap value as a figure. They may say 2 million or 1 million. But in this case, they are saying it is the 5% of the initial cost. What is the initial cost here? Is simple. It is the cost of the machinery. Okay, the 5 million. Okay. Also, capital allowance is to be calculated on what? On a 25% reducing balance basis. Alright. So when you have capital allowance, you must also calculate the tax savings on the capital allowance. And hope you remember that tax savings on the capital allowance is an inflow. It's an inflow. Yes, it's cash inflows. So it will increase the cash flows of the project. And there is no way you will calculate the tax savings on the capital allowance without you calculating the capital allowance first. Is that clear? So you see that. Next now, here we have investment will increase production capacity by 9,000 units per year. By 9,000 a year. That is the what? The annual production. Yes. The annual production. Now, let me tell you this now. When we invest in this machinery, okay, it's going to increase our annual production with 9,000 every year. So we are having 9,000 units every year. Okay, every year. That is the production unit we are going to work with. Okay, we are going to work with. Next, relevant financial information. So in current price terms, you know, I told you that there are two types of cash flows in appraisal: the real cash flows and the nominal cash flows. The real cash flows is also known as the current price terms. Okay, the cash flows before the consideration or application of inflation factor. Is that right? So all these cash flows here, the sales price, variable cost, incremental fixed cost, they are in their current price terms. Okay, they are in their current price terms. That is before the application of inflation rate. And they have their specific inflation rate. If you check, okay, the selling price is there, 4%, variable cost is there, and the incremental fixed cost. Okay. Also there is an initial investment in working capital. You can see. So there is also an investment in working capital. I have told you, there is no how you can embark on a long capital project without an extra investment in cash. You should need cash, okay, that you are going to maintain over the life of the project. So 500,000. Now, investment in working capital will be subject. Please help me to off your video, as you can. Thank you. Okay, will be subject to general inflation rate of 4.7%. Class, they are saying this working capital would be affected by inflation rate. It makes sense. It does. It makes sense because we don't expect our cost of activities to remain the same, okay, over the years. So 7%. Now, Tony Nigeria PLC pay tax on profit at the rate of 20% per year. 1 year in arrears. Be careful when you get your tax. Your tax can be paid in arrears or on the actual year basis. So when the question is silent, okay, is silent, it is on the actual year basis. Sometimes too, you might be told, okay, that that tax is paid in the same year, okay, but in this case, it's in arrears. That is, the tax of this year will be paid next year. The company has a nominal or money after tax cost of capital of 12%. You can see this question contains everything we have discussed. Now, I told you earlier that there is a difference between real cost of capital and the money or nominal cost of capital. Okay. So the money or the nominal cost of capital is that cost of capital after inflation factor has been considered. Is that correct? So that is the cost of capital that is inflated, okay, by inflation factor. So these are the things we have in the question. Sorry, we cannot read it out, okay, henceforth. Exactly. So let us be going this way. So you have the material with you. So now question 8. Calculate the NPV of the planned purchase of the new machinery using a nominal approach and comment on its financial acceptability. You see that thing there, that grammar is just to confuse you. What is money approach or nominal? In the question, we have inflation factors rate. So it is sure, it is sure that all the cash flows would be nominal or money cash flows. Yes, because by the time you apply inflation to the cash flows, you have changed the cash flows from real or current price terms to nominal or money cash flow. So the examiner shouldn't have told us that thing. Okay, that may confuse some students. Yes, the moment you apply inflation factor to a real cash flow, you have changed that cash flow to money or nominal cash flow. So class, let's start this right away. So the project here is 4 years. Is 4 years. Is a check. Computation of NPV. Question 3. 3. Timothy, Nigeria PLC. Computation of NPV. So remember, you start with year 0, year 1, year 2, year 3, year 1, year 2, year 3, year 4. This 3 is too close. Okay. I want to keep my figures in full. Yeah. I don't want to put 3 zeros up because that confused a lot of students. So let's have it in full. So class, the first thing, okay, is what? Is our sales revenue. Our sales revenue. Okay. This person is just coming and going out. It's having bad network. It's our sales revenue. Is that clear? So sorry. Sorry. Okay. Our sales revenue. And check class from that question, is the selling price having inflation factor? Yes, it has. Workings. Okay, is one. Sales revenue. You know, it is your selling price per unit times the quantity. Hello. And in that case, okay, the selling price is having 4% inflation. Selling price 4%, okay, inflation. There you have year one, year two, year three, year four. The selling price is for year one is 6, okay, is 650 constant, 650, 650, 650. Now, inflation factor based on the question at 4%, 1.04 year one, 1.04 year two, 1.04 year three, 1.04 year four. There you have adjusted selling price. There you have 676 70.04 731.16 760.41. That is the adjusted selling price. Okay, please class, if the question did not give you inflation, so it means you don't have to adjust the selling price. In the sales, what you adjust is the inflation. Sometimes they might give you incremental rate for the unit, okay, right? That is what inflation too for the unit. So no wala. Here we have the quantity now. This machine, if we invest in it, it will increase our production by 9,000. Okay, so 9,000 year one, 9,000 year two, 9,000 year three, 9,000 year four. Okay, then the sales now, revenue. Okay, after the inflation, excuse me, somebody is here. After the inflation, will be 6,084,000 6,327. Yes. Hello,
Okay, sir.
Kaka.
This production capacity, I thought that they said it will increase, as in production capacity by 9,000 units per year. Like every year will be adding
No,
extra 9,000.
no. No. Meaning what? We'll be having 9,000, okay? It has increased it by 9,000. So that 9,000 is constant, okay, over the years. Yeah. 6,580,440 6,843 690. Okay, that is our sales figure. The figures are large, but let us maintain it in that way, okay, to avoid confusion. So, sales Workings 1. Workings 1. Okay. Here we have 6,084,000 6,327 360 6 5 8 4 40 6 8 43 43 690. So after the sales now, what next? Less your relevant operating costs. And then what are these costs? Your variable costs, direct material, direct labor, okay, and also your incremental fixed cost. But here we have variable costs, okay, and I think it is also affected by inflation. Yes, what is two variable costs. Variable cost plus your total variable cost, okay, is the variable cost per unit times what? The quantity stored. Exactly. So the variable cost per unit times the quantity stored. You will recall under PM, under TP, okay, I told you that the total variable cost you are going to consider, it is the one that is actually based on the unit stored. So the same concept is applicable. So you have year 1, year 2, year 3, year 4. So the variable cost here before inflation 250 is constant. Please, I didn't put naira. Okay. Here you have inflation. At 5.5%. Yeah. 1.055, 1.052, 1.053, 1.054. Here you have adjusted variable cost, okay, per unit. The 263.75, 278.26, 293.56, 309.71. So the quantity now, the same quantity for sales, okay, is what you are going to use, oh, please. Because your variable cost is driven based on the unit sold. Your total, your total variable cost. See, your total variable cost. So you multiply Then you have 2, 3, 7, 3, 750. 2, 5, 0, 4, 340. 2, 6, 4, 2, 0, 40. 2, 7, 8, 7, 3, 90. So that is a adjusted total variable cost. Come here. You have your variable cost, working 2. For year 1, you have relax 2, 3, 7, 2, 3, 7, 3, 750. Year 2, 2, 5, 0, 4, 340. Year 3, 2, 6, 4, 2, 0, 40. Year 4, 2, 7, 8, 2, 7, 8, 7, 390. That is the variable cost. Here too, we have relevant fees cost, incremental fees cost. And of course, you know the concept, okay? And you know why we are considering these fees cost, okay? Incremental fees cost. That is also affected by inflation, 5%. The only fees cost we consider here is the specific or incremental or direct fees cost. The fees cost that is incurred purposely the cost of the project. So it means that if we are going to backpedal, we are going to change our decision as to the continuity with the project, the fees cost will not be incurred. So that makes it relevant. Is that right? Three. Incremental fees cost at year 1, year 2, year 3, year 4. So the original fees cost is 2 as on the fees cost 250,000. I can do it for you in a short cut, but honestly, that will confuse so many people since it is a constant figure. So inflation at 5%. That is 1.05. They were 1.05. Year 2. 1.05. Year 3. 1.05. Year 4. Here you are. They adjusted total fees cost now. Yeah. 262 500 275 625 289 406 303 877. We are done with that too. So let's put the fixed cost. Incremental fixed cost. Okay, steady. There you have 262 500 275 625 289 406 303 877. Class, is there any other item there that forms the variable cost or the relevant cost? No. So that is all. So let's find out the cash what profit. The cash profit. So the sales value minus the variable cost and incremental fixed cost of each column. Here I have 344 750. Please help me fact check. 3547 395 3648 994 at 3752 422. Plus, that is what our cash profit. Now, would someone tell me the next thing to do after we have determined this? Yes? Hello, class. What is the next thing after cash profit?
You deduct the tax.
Tax paid on profits.
Thank you. Thank you. The tax, correct. So the tax on profit. So at what rate there? It's at 20%, right? Okay. Tax on profit at 20%. And you know that the tax in this case is paid in arrears. It means the tax of the first year is paid in year 2. So it goes on like that. 0.2 times 3447 750. Here I have 689 550. So for year 2, 0.2 times 3547 395. Here I have 709 479 479. For year 3, 0.2 times 3648 994. Here I have 729 794 9. Yeah. The last one now for year 4, 0.2 times 3752,422. Now, this would make us now to create extra column, okay? Year 5. Is that clear? This is what you do to capture the effect of the task. 7,5,0,4,84. Hello, that is what you are going to do, okay? That is one of the conditions or the reasons why you will extend the years because of the tax effect, especially if the tax is paid in arrears. Then bear in mind that you are going to extend the original years of the project by 1 year, just to capture the tax. So class, after this now, what is our next step? Johnny? Yes, I'm waiting. Is what? It is your tax savings on capital allowance. Your tax savings, okay? By now, we should be flowing this tax savings on capital allowance. That should be working state 4. Now, working 4. Tax savings on capital allowance. And you know that our tax savings on capital allowance, it is the capital allowance times the tax rate. Is that clear? So it is expedient that we determine the capital allowance first, because you are going to multiply the capital allowance by the tax rate to get your tax savings. And that will form inflow. Okay, inflow. Here we have, let's say, the cost here. We have the capital allowance here. Yeah, the tax savings. On capital allowance. Now, let me put here. Yeah. So, what is the cost of the machinery? Is 5 million. Please, class, be with me here, okay? Let's say year 1, capital allowance. So the cost is 5 million. Okay, on what basis are you asked to compute capital allowance? It's on the reducing balance basis. That is what 25%. So the capital allowance for year 1 is 25% of this 5 million. Capital allowance is 25% of the 5 million. Class, that is what?
1,250,000.
Khalifa, yeah. Thank you. 1,250,000. Remember, in our reporting, FR or FE, one of the methods of depreciation is reducing balance method, okay? Or what? Diminishing balance method. So it means that what you are charging every year as depreciation will be reducing. Yeah, the same concept is applicable to capital allowance. So this now minus this, there you have the tax rating down value. Okay, that'll be 750. So in year one, we have charged this Abi as our capital allowance 1,250,000. So the capital allowance now for year two, okay, year two, okay, let's say the CE will be the 25% of the reducing balance method of the TWG, okay? So that is what?
937.
Is what? 9 what?
937,500.
Thank you. Okay. 937,500. So at the end of this year too, we also have the carrying value, but in tax is called the tax written down value. Please, what would that give us?
2,812,500.
2,812,500. Thank you. Now, the third year now, capital allowance, the CA will still be 25% of the tax written down value. So, what will we have there?
703,125.
703,125. Thank you. And you have 703,125. So, what would be the tax written down value there?
2,109,375. 109,375.
Thank you. Okay. Now, class, when you are calculating your tax savings, okay, on capital allowance, like I told you earlier, in the last year of that project, okay, you are not going to calculate capital allowance. You are going to test for balancing adjustment. Is that clear? So by comparing the sales proceed, the sales proceed with the tax written down value. So in this question now, class, what do we have there as our sales proceed? Okay, the scrap value. Yes.
5% of the initial cost.
Thank you. Now see, our scrap value, okay, is a 5% of the initial cost. That means 5% of the 5 million, right? That should give me here, I think, 250,000.
250,000.
Aha, that is our scrap value. This, by implication, in finance, is the cash we are going to realize, okay, when we dispose of the remnant of the machinery after the useful life. So the tax man is concerned that we do not cheat them. So since they are going to realize cash, then, so here we have the scrap value, 250,000. Okay. Now, class, if you compare this, okay, look at what you are going to realize. Oh, look at the carrying value of the what? Of the machinery. Is this scrap value up to this? No. So, what is the difference, please?
185,9375.
Is what? Okay, 185. Okay, 9375. To us is what is lost, Abi. This is called balancing allowance. Balancing allowance. out there. Now, by implication, hear me, the balancing allowance would represent our capital allowance for the last year. Is that clear? Okay. That is what our capital allowance for the last year. Come here. You have 1859375. So we now have the capital allowances. What is the tax savings? 20% of this, okay? Of this. You know, it is what your tax for savings is the 20%, the tax rate times what? Capital allowance. So what is for the first year?
250,000.
250,000. Please, class, let those I pick, right? Figures, so that the video is not too much integrated. Next, please.
187,500.
187,500. The next one.
146,25.
146,25. Okay. The next one.
371,875.
371,875. Class, all these are called the tax savings on capital allowance. Okay. They constitute additional cash inflows to the project. So you are going to add them. Mind you, you are going to follow your tax pattern, okay? Your tax pattern. Your tax is paid in arrears. In the same vein, you are also going to claim this tax savings too in arrears. So tax savings on capital allowance. The one for year one, okay, is what claim in year two. 250,000. It's an inflow. That is why it's not in jacket. The one for year two is what claim year three. 187,500. For year three, claim year four. 140,625. Year four, year five. 371. 875. That is what you are going to do. Please and please, your tax savings on capital allowance follows the same pattern with your tax payment basis. Is it in arrears or in advance? So that's that. Next thing, class. So is what is the investment now? Okay, you less the investment. The cost of investment here is 5 million. That is the amount we invested on the machinery. 5 million. And I told you that by default, it is always paid or what? Or incurred in year zero. In year zero. Yeah. Sometimes the question might tell you that part is paid in year zero and the remaining part at the end of year one. So you just follow what you have there. Initial. Okay. Cost 5 million. Year zero. Now, here we also have scrap value. You know, scrap value is an inflow. Now, what year are we going to receive this scrap value? Tell me.
Fourth year. Yeah.
Thank you.
Yeah.
In the
Yeah,
last
four.
year, in the last year, in the last year, in the last year, because that is the end of the what? We get like 250,000. I would have stopped here, but the question says there is an investment in working capital. So that is why we are going to also consider that investment in working capital. So how much is invested there? Let's check this. How much is invested? Please put your mind.
500,000.
Okay, 500,000. Okay, this is the amount invested. Now, it is also clear to us there that this working capital is subjected to inflation. Is that correct? So let's see. That'll be workings 5. Investment. Okay. You see, by default, class, working capital is always invested in year 0. Okay. Along with the investment, exactly, in year 0. And whatever is spent in year 0 would be recovered, okay, at the end of the project's life, in the last year of the project. So it means that in the last year is the year of recovery for the working capital you have invested. Also, I told you earlier that working capital can be increasing, okay, over the life of the project. So an increase in the working capital over the life of the project is an outflow. Yes, it indicates additional cash release. Why decrease is an inflow? It means cash savings. So what you are going to do here is that you are going to first get the adjusted working capital because it is affected by inflation. It means we should increase it because of the increase in the cost of activities too. So start what with year 0 as well. Year 0, year 1, year 2, year 3, year 4. So the working capital we incur 500,000. The last year is the year of recovery. So you are not going to put anything there. Now, inflation factor now. At 4.7%. 1.047 year 0, 1.047 year 1, 1.047 year 2, 1.047 year 3. So adjusted now working capital. Yeah, there you have 500,000. Here you have 5, 2, 3, 500. And you have 5, 4, 8, 105. Here you have 5, 7, 3, 865. You close like this, okay? Okay. Now, you know, your working capital class, okay, by default, right, is what is first incurred in year 0. Now you say changes, okay? Let's say changes, okay, in working capital or movement. Now in year 0, you first incur 500,000, right? Because that is the original amount you invested. Exactly. Before it is inflated because of the inflationary situation of the country out there. So this is the first amount invested. So it has to be in jacket. Now, we are now going to test now for increase or decrease. This will be the working capital in year 1. Now, this minus this, you can see what there is an increase, okay, of what 2,500. Also, between year 1 and year 2, this minus this, okay, you have what increase 2,4,605. Increase represent outflow. The same thing is done in your cash flow under IAS 7. Increase in working capital signifies that cash has been released. It's an outflow. So this minus this, there you have 25, okay, 760. You close now. Class, apparently, technically, we have invested all this, okay, in working capital. So how much now am I going to recover back? Year 4. Yes. Tell me. How much are we going to recover back in year 4? It is the sum of all this, okay? They are all outflows. This plus this, the sum. There you have 5, 7, 3, 8, 6, 5. Exactly. It is the sum of the cash outflows. Yes. Supposing you have 1 year that is what decreased. So the decrease would have been used to reduce what you have here. Exactly. So let's go now and post that to working capital. Excuse me, I'm coming. I'm coming, please. Okay, go on.
Hello, sir. I did not get the last thing you said regarding the working capital.
Now, I said if one of these outflows, okay, is not in jacket out there, supposing what we have here now, example, okay, is not up to this. So if you say this minus this, okay, so it will be in jacket. So that means there is a decrease. So the decrease will be subtracted, okay, while you are adding up. So that will effectively decrease the amount you are going to recover. Over there. So working capital. So here you what we first incur 500,000 in year 0. So in year 1, 2, there is an extra outflow 2, 3, 500. In year 2, extra outflow 2, 4, 6, 5. Year 3, extra outflow 25,760. Now, here for now, we are going to recover all this investment. That way, 5,73865. So that is how you are going to treat. Okay. Sometimes in the question, the working capital might not be affected by inflation. Okay, right? There won't be inflation. So in that case, it is what you put in your zero that you will recover in the last year. Is that clear? So these are the two ways you can have it. That is, sometimes the working capital might not be inflation affected, right? So it is what you put in year zero that you are going to still recover in year 4. So it means that there won't be increase here or decrease. It is just year and year. We only have this because of the movement, the changes in the working capital. Okay, go on, Kalista.
Okay, sir. My question is on that tax saving, right? Assuming we
Okay.
don't have balancing allowance, we had balancing
Okay.
allowance because our scrap value is lower than the tax written
Yes,
down
yes,
value,
yes,
right?
yes,
Assuming we don't have balancing allowance, are we still going to use the value as our capital allowance?
yes, yes. So in that case, then okay, it means what we have. Wait. Don't say okay. If you don't have, okay, you see, balancing allowance, right? Class, hear me now, will occur if the carrying value is more than the scrap value. Okay, alright. And it is the balancing allowance that give rise to additional capital allowance. So supposing the scrap value, okay, is more than the carrying value, what you will have is balancing charge. Is that right? So the balancing charge represents additional income to us. So in that case now, what happens? You are going to calculate extra tax based on your tax rate on the balancing charge. So that would be extra tax paid. It will be in the last year. Are you clear now? Are you clear? Okay,
Yes,
go on,
sir.
Cynthia. Go on.
Okay, sorry, I didn't really get the calculation of tax saving because I was having network glitches. How we got the
Hey.
tax on capital allowance?
Is it the okay? Now we have cleaned the workings, anyways. Okay, maybe when you watch the video, but what we do is that you are going to first calculate your capital allowance for each year. Okay, like your normal depreciation, based on the reducing balance method. You will say the cost less what capital allowance. 25% of the cost will give you capital allowance. So you will say the cost minus the capital allowance, you will have the tax written down value. For year 2 too, you will say the rate times the tax written down value. You also subtract. It goes down in that manner. Okay, in that manner. Sorry, we have cleared that. So we are done now. Okay. So let me finish this thing. This thing is wide open. Okay. So our net cash flow now, here we have 5.5 million. Out there. So please, Calista, oh yeah, for year 1, this less this is what? why I take here
3,424,250.
Thank you.
Yes.
So this minus this plus minus. The ones in jacket are outflows. Okay.
$3,083,240.
what?
3,083,240. 083,240. 083,240.
Okay. 80,000. Okay, 80,000. Sorry, 240. Next. 3,083,000. Okay, next one, please.
Three
3,1,260.
Is what? 3 what?
3,1,01,260.
Okay. Next one. Okay. Yes, for the fourth year. Yes, yes. I'm waiting.
The third year should be 255, sir.
This one.
Yes,
Okay.
sir.
255. So thank you.
So
The
the
fourth year.
fourth year, 3,987,113.
Thank you. Now, these are called the net cash flows. Okay. So, first, let me ask you now, what kind of cash flows do we have in this project? Tell me. Hello, class.
That cash flow, nominal
What?
cash flow.
Thank you. Nominal or money cash flows. Why? These are the cash flows after we have adjusted for inflation. So, if they are nominal cash flow, what kind of discount factor then are we going to use?
Just
Nominal.
nominal discount factor.
Thank you. Thank you. So, in that question, the discount factor we have there, is it a nominal one or real one?
It's nominal discount factor.
So, no need for adjustment, Abby. So, it's nominal already at 12%. So, for year 0, year 1 is 0.893. Year 2 is 0.797. Year 3 is 0.712. Year 4, 0.636. Year 5 is 0.567. So let's get our PV now. This times as you have here, the same thing in brackets. the PV. So what is the PV for the year one? And that. Let me do the last
3
year.
million.
Is what?
3 million zero
Yes.
57. 3 million
057.
057. Right.
Okay.
855.
855. Okay. Next one. 0.567 times 378,609. Yeah, I have 214,671. Okay.
The third one, 2 million.
Okay, yeah, we 2 million. Okay.
Yes, sir. 457.
457.
342.
Okay.
342.
Thank you. Okay. 0.603.
2 million.
Okay.
2 million
Okay.
208,094.
20094. Thank you. Okay. Last one now.
25.
Okay. 25. Okay.
35.
35.
80.
Okay.
803. 3.
8 what?
Point.
803.
3.
Okay. So class, the question says find the NPV, right? Yeah, question A, find NPV. Question A says NPV. Now, what is NPV? The summation of the inflow, okay? This plus this plus this plus this. These are the inflow. So minus this and this. Tell me now. Therefore, the NPV is what? Help me add together. All these ones, these are inflows because they are not in jacket. Remember, NPV is the difference between the present value of all the cash inflows and the cash outflows. So we have two cash outflows here, this one and this. So help me sum together. 1, 2, 3, 4 minus this and this. Okay. What do we have here?
Four million 544,423.
4,544,423. Okay. Come in. Okay. 4 million
4, 5,
5
4, 4.
4 4 2 3. Now, is there anything there like decision?
Like what, sir?
Yes. In that question A, check. You are asked to compute the NPV, and after that, is that all? And comment on its financial acceptability. So, should we embark on this project? Yes, let's go
Excuse
on.
me, sir.
Huh?
This year five, from the question we have 4 years, right? This year five,
Yes,
why are we including it?
because the inflows here is not up to the outflow. So you are going to have the net cash flow in jacket. Are we there? What we have there as inflow is 371,875. And the outflow here, the tax is more than. So you give us what? Negative. So that will result in that too. Okay. So decision. Okay. The project should be accepted because it has a what? A positive NPV of 4,544,423. Yeah, it is financially what viable. So it is going to add to the value of the shareholders. Yes. So had it been it is negative, you know what to do on the ground of NPV. When a project gives you negative, you should just stick to your yield. It should not be accepted, okay? But here it should be accepted. Why? It gives us positive NPV. So that is that. Now the part B, sharp sharp. Yes. Please, Sandra, help me to off your video, please, okay, so that I can give you the part B. Thank you. The part B says discuss the difference between nominal approach, CO, and real terms approach to calculating NPV. The examiner in this case just wants to pull your legs. Yeah. He's trying to ask you, discuss the difference between the nominal approach and real approach. So let's see. Let us take it now. I will give us short move here. Sharp, sharp. Now, discuss the difference between the nominal or money approach and a real term approach to NPV calculation. So the first one here, let's say nominal. Okay. Or money approach. So investment appraiser, okay, uses nominal cash flows and nominal discount factor to determine the NPV out there. Now, class, as you know that under nominal, when the cash flows are in money terms, you must also use what? Money discount factor. Exactly. You must also use. So, nominal cash flows refer to inflated cash flows. Inflated cash flows. Yes. That is cash flows. The cash flows gotten after applying an inflation rate. Exactly. Why? Nominal discount factor as well is the discount factor derived after adjustment for inflation. Okay. Exactly. The nominal discount factor can equally be determined by using Fisher's equation. Fisher's equation, say 1 plus M equals to 1 plus R, 1 plus what? 1 plus I. So that explains that, okay. You know, sometimes you may have to convert the real discount factor, okay, to what? To the nominal discount factor by using Fisher's equation. So where the M is the money, or nominal discount factor. The R is the real discount factor. The I is the general inflation rate. You know, I told you, it is the general inflation rate that is used, okay, to adjust for the discount factor. You know, there are two kinds of inflation under appraisal. We have the specific inflation and the general. So next now, the real term now. The real cash, real approach. Okay. real terms approach to investment appraiser. Uses real terms cash flows and real terms discount factor to determine the NPV of the project. So I think it is also better we explain the meaning of real term cash flows. Okay. Real terms cash flows refers to the cash flows before the adjustment for inflation. Okay, that is uninflated cash flows, while the real term discount factor refers to the discount factor before adjustments, okay, for inflation too. Is that clear? So you see now, this is a standard exam question. So by now, I expect us to know the difference between the money cash flow and real cash flow. Okay, money cash flows are the cash flows you derive after you have adjusted them for inflation. So you can say inflated cash flows. Okay, so therefore, under appraiser, you use the same relevant cash flow to appraise the money cash flow. So money cash flows are appraised with nominal or money discount factor, like for like. The same applies to real cash flows. These are the cash flows in their current price terms. That is the cash flow before we consider inflation. Okay, that settles that. The next one now, question C part. Calista, please, would you help me read that?
Okay. Identify two financial objectives of a listed company such as Tony Nigeria PLC and discuss how
Okay.
each
Go on.
And discuss how each of these financial objectives is supported by the planned investment in new machinery.
Okay, thank you. Financial objective. Okay. Of a listed company. Like what? Timothy, Abi? Timothy Nigeria PLC. You see, this is the first thing, okay, in your syllabus the meaning of financial management, and you talked about all these objectives. We are coming there to have 2 days lecture on that. It is theory. It's also important. Or my second colleague will do that for you. So let's see, class. The following are the financial objectives of Tony PLC. The following are the financial objectives of Timothy Nigeria PLC. 1. Maximization of shareholders' wealth. Yes, one of the major financial objectives of a firm, okay, is to maximize the wealth of the shareholders. Yes. 2, the share price should be increased. 3, dividend and capital gains. 4, profitability. The 5th one now is growth. Class, these are some of the financial objectives that a firm would love to achieve. Actually, the objectives of a firm can be broadly classified into 2: financial objectives and non-financial objectives. Is that correct? So those ones that are financial are the ones that can be measured, okay, or represented by figures. Is that correct? So let me give us short note on it. Sharp. One is maximization of the wealth of the shareholders. Maximization of the wealth of the shareholders. Of the ultimate goal of a listed company is to maximize the wealth of its ordinary shareholders. Yes, that is the first ultimate goal. Okay. Number 2, share price. Share price. Is it clear? To share price. Let me change this marker, please. Okay, share price. Now, wealth maximization means, okay, increasing the long-term market value of the company's shares. Yes. We must also strive, okay, to increase the market value of our share, because that is when the shareholders' wealth can actually be maximized. Next, dividend and capital gains. Okay. Shareholders gain wealth through cash dividend, okay, and rising stock. Yes, stock prices. That is capital gain. So the shareholders gain wealth, okay, through what? The cash dividend they collect every year, plus the rising stock prices, that is the increase in the price of their share. That is capital gain. The next now, profitability. Now, generating, okay, higher returns on the invested okay, no, on the money invested in the business. Okay, this is measured by return on capital employed or return on what? On equity. Okay. The fourth one, fifth one, growth. 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 When we say growth, this is very key. Okay. Growth what means increasing revenue, earnings, okay, increasing revenues, comma, earnings per share, your EPS, okay, and market value, okay, or share over time. Over time, growth must be profitable. Yes, to add value. Yes, that is the growth we experience must surely add value. Now, growth means what? Increasing revenue, okay? Revenue, increasing revenue, earnings per share, the EPS, okay? Increasing revenue, earnings per share, and market share over time. So growth must be profitable to add value to the wealth of the shareholder. Please, class, add this to it now. Last, right? Note. Let us add it out there right now. The investment in the new machine. Would enable Timothy Nigeria PLC. Would enable Timothy Nigeria PLC. Would enable Timothy Nigeria PLC to meet the increase in demand for its products out there. And the company okay, expect to be able to sell. Okay, the company expects to be able to sell all the increase in production, at a profit. So that is where we are going to stop. The last one, okay, will be taken as a topic. Yeah, debt covenant. It is in the material I gave you, that lecture note on the sources of finance. Don't worry, we are going to have 2 or 3 classes, okay, for the theory. So please, any question, class? Yes, class. Any question? Okay. Go on, sir. Isaiah, go on.
Good evening, sir.
Yes, sir.
Thank you once again. But sir, honestly, I want to know, is this the only way we can calculate this approach we took today? It's a little higher than what we did before. So I'm asking, is this the only way?
You see, what we have here, okay, is that this question contains all the normal things. 1, it includes the inflation, right? 2, working capital. 3, tax savings on capital allowance. So, and these are the things that you must see in a standard investment appraisal. Exactly. So, if you are going to get anyone, it may be less than this or be at this level. So, these are the things you are going to see, because it consists of all the normal components of a standard investment appraiser question. Are you clear, sir, with that?
Yes, sir.
Are you clear? Okay. Zainab, go on. Zainab, go on.
Good evening, sir.
Mhm.
Well done, sir.
Yeah.
Mine is actually a question. I just say let's appreciate you, sir. You are really trying your best. You are doing well. Though my network
Thank you
things
so
I
much.
join has not been sending, but still, with the look of things, sir. Thank you very much for your efforts, for your time, and for everything. Really appreciate you, sir. Thank you.
Okay. Thank you very much. Thank you. Thank you so much. So, can we close now? Hmm? Class. So we are done. See, I took this question so that you can have time to go through it out there and get yourself acclimatized to the nature of this question. You could see that this is not the same with the one we saw last. So this is the highest you can have, having this adjustment, working capital. In fact, this one has working capital with inflation. Okay, so no issues. Okay, the one we are going to do last will be how to correct the investment appraiser that has been done before. Okay, how to correct the appraiser that has been calculated before by the accountant or anyone. Exactly. So after that, we move to business valuation. Okay, so we still come back to take some things. Thank you very much.